Hi, and welcome to From the Research Chair. This is episode 20, Refinements to Macro Investing. I'm Jason Voss.
And I am Michael Falk. Refinements is quite the claim.
So, Michael, how did we come to this subject? Why did we hit this note? Like, what's our interest in this?
Can I start with a quote?
Yes.
There are these two young fish swimming along, and they happen to meet an older fish swimming the other way, who nods at them and says, "Morning, boys, how's the water?" And the two young fish swim on for a bit, and then eventually one of them looks over at the other and goes, "What the hell is water?" David Foster Wallace. This is water. Some thoughts delivered on a significant occasion about living a compassionate life. As investors, if I can only, and I can do more than only, but if I can only say, if you do any discounting of cash flows to assess a value, you're using an interest rate, I presume. That's water. Interest rate is the environment in which you are investing. You cannot divorce your security level work, from work that pertains to the economy. Now, you can claim that the economy, interest rates, who knows the direction of those, or other such macro type of topics are so difficult to predict, why bother? But you use them as inputs in your security work. So, Jason, what the hell is water?
Well, for me, water includes more than just the economic environment. I would agree economics tends to be difficult to predict precisely, but magnitudes and directions tend to be pretty easy to predict. Interest rate policy, there's a lot of transparency on, but there are other macro issues that people overlook as well. It doesn't get more macro than the weather or the climate. For example, how could this factor into your investing process? Have you ever looked at the manufacturing facilities of the businesses in which you invest and noticed if they're along rivers, seashores, so on and so forth? That's a macro level concern. Geopolitics, I think, is one of the, and we've said this before on the podcast.
Well, we have interviewed a friend of ours who's written a book about geopolitics.
We have indeed, Mr. Joaquin Clement. And geopolitics is, I think, a macro level thing that is easily predictable. So I don't think that macro is unpredictable, but these things are sort of, I would say, hidden partners to the typical bottoms-up investor who's doing these things usually with not a lot of sophistication. Michael, what's water to you?
Well, can I just start with a popular or unpopular topic these days, global warming? We're not going to dive into ESG per se, but if global warming exists, okay, there's science, it exists. All right, if the oceans rise 1 meter, 1/2 meter, 2 meters, I'm forgetting about the size and the time frame. If you've got commercial real estate, residential real estate, manufacturing real estate near shoreline, that is a real risk. Global warming, Jason, now I've introduced the weather as a macro. Listen, again, it's water, folks. Anything you're investing in operates within the whole wide world. What is going on elsewhere in the whole wide world? You know, one of the things that sticks in my mind, all right, so some of us are old enough to remember circa 2000, okay, and the tech bubble. Okay. We can advance to 2008. Let's just talk about the housing bubble. Okay. Value investors per se got absolutely crushed going into the 2008 Great Recession. I still quibble with why we call it great. It's a separate issue I have. All right. And when they interviewed a bunch of those value investors post that experience, they said, what would you do differently? And on average, there were two answers. One was nothing. Really? Have you learned nothing from that experience? The other was, I would consider the macro a little bit more, because they got crushed by over leveraged investments, and they didn't factor in interest rates.
So let's back up a little bit, because we need to, I think, get a little higher specificity here. We promised to define macro versus micro for the audience. Water is a little bit abstract, a little bit abstruse, which is very Michael and Jason. Michael, what the hell are we talking about when we say macro investing?
I would dare say any factor, I'm a little hesitant about using that word because it has different meanings to different people, any factor that can influence the success or failure of a business that is external to the actual operating of that business. That's how I think of macro.
Give us an example.
Well, I've given you a couple. Interest rates. Jason, you spoke about geopolitics. I spoke about global warming. These are all things that are external to most businesses' actual raison d'etre. Why they exist. They don't have any control over them, but those things can pop up and bite them on the backside.
So talk to us a little bit, Michael, about your background with macro investing. I was much more of a bottoms-up guy, though I have a training as an economist. I also cared very much about geopolitics. Talk to us about your background in the kinds of factors that you emphasized in your work.
Yeah, I used to use an investment. I was the chief strategist on a global macro LP. So I kind of did this for a bit. The way I thought about it is there's two types of investments. And I'm going to go deeper, so this won't be so offensive at first. There are long-term or strategic allocations, and there are shorter-term tactical allocations. Okay, strategic allocations, you want to try and imagine what can be evergreen, things that you rarely have to make any changes with. Tactical would be about short-term dislocations, opportunities in the market. Something experienced a crisis. Something has got some sort of momentum. Okay, but they're two distinct types of investments or for potential benefit within a portfolio. So some people think of this in different ways, core, and then we'll explore, and the explore is tactical. I don't happen to agree with that, but some people do think of it that way, and I don't want to disallow it, even though I'm not a fan of that. So if you think of equities, okay, equities, we could say broadly, listen, business is going to continue. Equities are going to continue. They belong in the strategic side of the portfolio. Now we can go deeper and say, well, where in the world do we want those equities to be? Do we want them to be public or private, as an example? We have to answer those questions. When we go on to the debt side of the ledger, we have to ask ourselves, okay, do we want debt in the portfolio? You know, real interest rates, broadly speaking, are negative around the world right now. That is not long-term success. Why would we have any debt securities in the portfolio right now? Now, that's a macro thing. That doesn't mean there are not individual debt securities that might be really valuable for a portfolio. But the asset class, careful. Be very careful when you're buying negative real. Crypto, all right. Is this an asset class? No. This wants to be an asset class. It's not an asset class. That doesn't mean, however, in the short run, it may not be a valuable investment for people. But folks, tactical only, that is a speculative type investment. It cannot be evergreen. And some of you are thinking, if you're a crypto fan right now, Michael, how can you say it cannot be evergreen? Once every major sovereign country in the world goes to a digital currency, it's going to happen. I just don't know when. Every single crypto gets relegated to the background, back channel, dark channel only.
So, Michael,
in size.
So, ironically, we're kind of, in my opinion, a little bit in the weeds here. Ironic on a macro call. Talk to us about Evergreen. What qualifies as Evergreen? And then answer the question, where is the best return available typically? Is it in the Evergreen stuff or is it in the tactical stuff?
Evergreen, best return is hard to say because tactical can't compound. It's about capturing a return. So I'd say evergreen is where the greater returns are. Finding the evergreen. What industries are not going to go away, right? So let's go back a second, right? Warren Buffett, long time ago, somehow somebody got a quote from him. I won't invest in technology because I don't understand it. And they hammered on him about, oh, come on, what's wrong with you, man? I think they had a word old before man. Listen, he understands technology, folks. Don't be confused. What he says is, I can't look into the future and understand which technology is still going to be here or which one is going to disappear. Railroads are evergreen, as an example. We do need to ship stuff
cheaply
over land.
And cheaply.
Cheaply. Shipping is going to be we are going to always need to ship stuff over water. Well, there's that water. No, we're not doing that. We're not going back to the water again. There are things like this that are evergreen. The need for more energy production over time. Where is it going to come from? Energy need is evergreen. How it's going to be satisfied, different topic. Right? So I can go in different dimensions of things that are evergreen. It doesn't necessarily then tell you what security to buy.
So is that our first level refinement? Our title of the podcast today, Refinements to Macro Investing. Refinement 1, identify those things, macro level, that are evergreen.
Correct, because everything else is tactical and you may not want to play there.
Okay, so now my next question. Convince me this isn't just beta, smart beta.
Well, first of all, if you want to bring in the word beta, that's fine. I have no problem with using the word beta.
For our audience, you have no idea that I just like smacked Michael upside the head.
Rob Arnott coined the term smart beta many, many, many years ago. What a lot of people don't know about Rob Arnott, I know Rob, is he is one of the most brilliant investment marketers you could ever meet. He chose the word smart in front of beta as marketing 301, not 101, not 201, 301, because it forced the argument that all the rest of the beta must be dumb. No, let's just stick with beta. Let's not give it a validation of any type or sort. Jason, I could argue it's a different type of beta, meaning beta that will persist versus beta that will fade. Right? We talked about evergreen versus tactical. Beta has been misdefined for almost as long as it's existed. Beta is the expected return based upon the risk level of any asset or asset class. And there's going to be drift or lack of correlation, but at the end, law of large numbers, it all has to add up to one beta. So, Jason, I'm not going to let you cheat this. It is a form of beta, but maybe we talk about it differently. Evergreen beta versus beta that has some level of risk of fading.
So in other words, predictability versus unpredictability, skill versus luck.
Yeah. Demographics, right? Demographics are probably the single best long-term predictive data set that exists. How many people will be alive in 20 years and 30 years? Based upon longevity, based upon fertility rates, based upon. This is proven to be one of the greatest data sets throughout history for long-term predictability. A lot of people ignore it. Then a lot of people say, well, nobody's ever made money off of it. Well, have they used it correctly? Generally speaking, within the data set of aging, what are the highest spending age cohorts? Why don't we start to dig into those data sets? Because I'll tell you, there is gold in those data sets.
I will give you an example. And this, Michael, you know, I look at demographics, and it's one of the inputs into scenario planning, also one of our podcasts. And I think there's a fairly strong argument to be made that the reason why the global economy has been sluggish post the, whatever you want to call it, recession, the Great Recession, is not so much because of misallocation of capital, but if you look at the demographic picture, it's not favorable. And there's the Gen Xers, my generation, is the smallest in history over the last 100 years. And I think the economy is absolutely feeling that. And I did a statistic a couple of years ago, which was global economic growth adjusted for population and the slack that is there for the population. And it explained most of the economic slowdown.
It was,
go ahead.
This was the core storyline that began my 2016 CFA Institute Research Foundation monograph. Folks, do you know one of the proxies for GDP in a country? Population growth plus productivity growth.
Ding, 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 ding.
Population in many parts of the world is already starting to slow down and shrink because fertility rates around the world have been dive bombing. Fertility rates are dropping. If you want to know more about it, buy this book, by the way, free download on Kindle. You can get the book for free, folks. I'm not selling a darn thing to you.
So what's funny about that is you and I, Michael, we've never talked about this before. This has literally just come up. I wrote a piece for CFA Institute about the fact that GDP is such a shite measure of economic growth, which is getting more from the same pile of resources or the same from a smaller set of resources, that productivity and multi-factor productivity is a much better measure of actual economic growth, because GDP mostly is what I call more mouths to feed problem. This is an example, I think, of where macro investing.
It could be a benefit, not a problem. If you've got more mouths to feed, that's a greater incentive to produce more.
If production ultimately is something we want to maximize. If output is to be maximized, don't you think efficiency better to maximize? That's a whole nother podcast.
Yeah. So all right. So this is where I get to say robots are not evil. Robots are not going to take everybody's job. Robots are going to be our savior for a shrinking population to help maintain a level of productivity to possibly, not probably, possibly offset the decrease in population growth. There are pieces to both population growth and productivity growth. There are 3 to 4 major pieces underneath each of those that you can analyze in the macro to help you make investment decisions.
All right, so we also promised to answer the question or address the issue of functionality of macro and micro. Notice I didn't say versus, macro and micro. Michael, what did you mean by that?
The way I think of macro in the context of managing a portfolio, right? The job is to manage the portfolio, so we can't get lost in the weeds, as I like to do, right? Find the securities that have a basis to exist with your client's money. Yes, I said that very strategically. Securities that have a basis to exist with your client's money. Then examine or commensurate with the purchase. Review the macro. I like thinking of the macro as potential risk, and then it's a go, no-go decision. Find the security, examine the macro, and the macro is the go, no-go decision on the security. So I like it as risk management. Remember, I try and divide the portfolio into two pieces, more evergreen, more tactical.
So what do you say to a bottom-up investor who says that's management's job to manage macro factors?
Depends on who management is. I'm not offended by that, by the way. If you've got an analyst whose job is to pick the best healthcare, industrials, financials, tech, doesn't matter what.
I didn't mean the PM. I meant the people who run the businesses, who issued the stocks, who issued the debt, who issued the warrants.
Oh,
etc.
I think that is hopeful, and hope is not a strategy. The way that we incent most corporate managements these days, these are not long-term incentives. They're short-term incentives. Macro, if you align with my thought or thinking that it's more evergreen, management's not getting the job done. Not the way that you might want to use these ideas for your portfolio. Does that help?
It does help. And I agree with you completely. To me, I thought as an investor, there were certain things I had to have a view on, whether I wanted to or preferred to have a view on. And you mentioned interest rates, which to me is the most obvious and biggest one. That can, like, the economic scene affects almost everybody. Not so interesting. They go through cycles, blah, blah. Geopolitics, absolutely. Demographics, absolutely. Major government spending programs, absolutely. I felt was my job to understand and to discount. So, Michael, I'm going to go back to our water theme. One of my favorite analogies is the crocodile at the watering hole, right? So you're a bottom-up investor. You go to the watering hole to get your sip of water. You've basically said macro factors are the crocodile lurking below the surface, and you better beware. You better know what's going on.
Yeah. You know, 1 sip, 2 sip, 3 sip, crunch. You know, if there's a crocodile lurking below, you're going to learn, and then you're not going to ever benefit from the learning because of the crunch. We always want failure to promote learning. When people, you dipped a toe. I'm going to put the whole foot in. Risk management for a portfolio, you want to know where it starts? Don't buy bad securities.
Duh.
Oh, yeah, I went there. That's risk management, folks. Number 2, that's number 1. Number 2, diversify what you own. Shocking. Spread your bets just in case something does go wrong. Point number 3, and by the way, there's only 3 points. Have a sell discipline that you use consistently that works. You can use all the software, all the computer programs, all the quantitative analysis you want. If you can execute 1, 2, and 3 well, you've got better risk management than most of the other portfolio managers around.
So let's hit the refinement note. We hit one refinement, right? What are other refinements to macro investing? What do people not get about it? What do they fail to do well with regard to macro?
Jason, I'll reach back to the podcast a little bit we did on scenario analysis, right? So the macro environment is going to respond differently in different scenarios. All right. So last night, President Biden of the United States, I don't know where all of our listeners are located, set out kind of his agenda. And his agenda is for bigger government. I'm not going to give you a good or a bad on that. I'm just going to say it is. If his agenda passes, that has major implications for parts of the economy, both positive and negative. We have to pay attention to these types of things. It's as simple as that, isn't it?
So refinement 2, pay attention to the political scene.
Pay attention to where money is going.
Aha!
Is money flow macro? Do we want to talk about M2? I'm sorry, I'm back in the US. Please excuse. Everybody's got their own version, right? Do we want to talk about the velocity of money, how it's moving around in the world? Not how much exists, but is it moving or is it just lying there, right?
Capital flows, by the way, I think one of the great unappreciated data sets. Very few people look at them. Michael, you and I in our work with fundamental investors, and by the way, note that Michael and I talked about the different, is value versus growth a legit distinction? We said, no, it's not. It's really fundamental versus momentum. Even though, Michael, you committed the sin earlier, you said value investors. But anyway.
Well, no, because I was talking about people who were interviewed after the Great Recession. They called themselves value investors.
We'll call them fundamental. In any case, the capital flow data is fascinating, and it shows, I think, because once the capital has moved, it tends to sit there for a while. It's more a hippo than a gazelle. It sits there. Yeah, I try to riff off the crocodile. I've been on safari before. Anyway, it's more a hippo than it is a gazelle. It tends to sit in the water for a long time and not move. And so once those, if you notice big capital flows moving, they tend to be sticky. They tend to hang out there for a while.
Yeah, because there's an old adage, money is going to flow or go to where it's going to be treated best. And once it's treated well, why would it leave? It's going to be patient. It's going to. These are things, so, Jason, it could be as straightforward, I don't want to say simple, straightforward as a dashboard. Based upon the fundamental investor and where maybe their investment philosophy leads them, create a macro dashboard that has X number of things down a list that actually impact the businesses that you tend to look at in your fundamental investigation. And find the security. I like XYZ. Great. Let's go to the dashboard. How many of the dashboard are green versus red? And if you have, by the way, I like having the dashboard an odd number. And I like a majority green. If not a majority green, don't invest.
So I love that you've said this. You've heard me share this only with one of our clients ever, because it was one of the top secret alpha generators. I'm going to take it out of beta. I thought it was an alpha generator, mostly because of preservation of capital. The way I tended to look at risk was I created for myself a qualitative framework of risks that tend to recur when you operate a business. And I think I had 17 of those, odd number, check. And I then evaluated them from 0 to 5 in terms of the exposure of a business to that factor. Why is that important? How does that make me money? Some of these factors, like the weather, are hidden, right? As a possible risk factor in your portfolio, a macro factor. Let me give you an example. In what way is Six Flags similar to power generator AES? Six Flags is an amusement park.
Yeah, I just was going to say, define that just in case people don't know the company.
Yeah, Six Flags amusement park, AES a power company. Well, AES has hydroelectric dams that they use to generate power in Brazil. And if they have a bad year, rainfall-wise, they can't deliver on their promise of delivering power to the Brazilian government in X number of megawatts that they have promised. Six Flags has a similar thing. If the weather is bad, then during their operating season, which is only 5 months of the year, then they have problems. by identifying weather as a risk and then looking at the weighting in my portfolio, I was able to avoid taking on too much of these risks, which look very different than valuation, that look very different than interest rate. And I had a variety of factors that I looked at. I don't want to give all of them away. But in all these years, I've been retired since 2005, I've never seen anybody else who's doing a similar sort of a process.
Yeah.
They've identified these things that affect all businesses, looking at the portfolio view to see, am I taking on untoward risk? In my portfolio, I had about 20+% weather exposure, which was a hidden risk in the portfolio because I also owned Vail Mountain Resorts, right? That's a weather risk, et cetera, et cetera. So that's another way where macro level risks and understanding of them at a portfolio level, not at a beta factor level, but an actual, hey, all businesses face and confront these things. Refinancing is another one. Your ability to roll over your debt is another one. I digress.
Well, what I like about what you just said, Jason, is really important to be repeated in case people didn't catch the nuance in it. When we talk about macro, it's not about the level of predictability. It's about a respect for the potential impact. So when we talk about that you had 20% of hidden weather risk in your portfolio, that's an acknowledgement that weather could really do damage to your portfolio. It's not a prediction that it will or will not, but you have to then, as an investor, answer the question, do I want that much weather risk in my portfolio? It's not a right or a wrong. It's your judgment for your portfolio. So what we're imploring is, it's water. You have to understand you as a little fish are swimming in this thing called water. And we're just describing the different dimensionality of water in our case.
Yeah, so to complete my thought about what I did, if anybody in the audience is interested, I also evaluated, I said 0 to 5, 4s and 5s.
An odd number.
An odd number. And the 0 is in there, by the way, because I wanted the average to be 2.5. Or not to be 2.5, but to be 2.5. If something was above 2.5, I considered a greater risk. But anyway, I also identified the 4s and 5s in the portfolio. How much extreme risk do I have in the portfolio? And even though it may be a small portion of the portfolio to which I'm exposed 4s and 5s, in terms of the Pascal's wager, if in fact those 4s and 5s manifest, I ain't going to heaven, right? I'm going down to hell. And so I also wanted to identify that. And then the other refinement there to reveal is I asked myself the question, and this was in part what determined whether something was on that 0 to 5 scale, is it manageable on the part of the management of the businesses in which I've invested? If it was not manageable, by definition, it's a 4 or a 5.
Yeah. Yeah. And again, where I like where you finished your thinking, because it comes right back to how I like to think about macro and what I want to share with our listeners. It's a form of risk management. And Jason, what you talked about, I said there's really only 3 things. The pinnacle of risk management. Don't let crap into your portfolio, step 1. Step 2, because we don't always know what crap looks like ex ante. You diversify. That's what we're talking about. We're using macro as a way to assess potential crap. If we miss it, let's diversify amongst different macro themes so we don't have too much risk exposure. And then if we do happen to make a mistake, let's get rid of it. Sell it. It's risk management. Do your same fundamental work, but don't neglect. I think that's the word I want. Don't neglect that business operates in water. You need to understand the water. Maybe use a dashboard, as we've talked about.
So, Michael, we're nearing the end of our time with our beloved guests. Talk to us about your process, right? If you what are the components of this machine or this model or this framework that you had created?
I used a combination of demographics and deeper slices within the demographics. I like to look at prime earning years. I don't care if you got a whole bunch of babies, that's not going to necessarily help the economy. Okay, you got a whole bunch of old folks, not necessarily going to help the economy. I look at the density of prime earning years within the demographic within a country. I look at the balance male female, right? Do we have males being calmed by their females? I'm sorry, that's old school thinking, but I'm going to say it anyway. Or do we have an exorbitant number of males compared to females? Are they going to run around and break things? Okay. I look at those things. Then what else do I look at? I like to look at beyond that. I like to look at the level or success of capitalism, rule of law, housing, right? Because then that starts to get into private ownership. That starts to get into incentives for private wealth gains. So I start to look at policies within the demographics that I like. And are they favorable or are they unfavorable? These were always my first steps of macro. And they were longer term bets. There's no question. Why wouldn't they be? It would help me understand. Then I have to think about diversification. Do I really need to invest in developed Europe, as an example, if I have US investments? Or vice versa, if I've developed European investments, why do I need to invest in the US? Maybe I'm not getting lots and lots of diversification there. Maybe I'm not getting as favorable a demographic or a political landscape. Don't even get me going on the euro and issues. All right. However, when I start getting into demographics, I've got to go into developing economies. They behave differently than US or developed Europe. So I start to pull apart the world. I look at aggregate beta, Jason, for equities, and I start to pull it apart into broad pieces to say what can be used to benefit something else. And how do I think about the exposures on the macro?
See, I love that you just said this, because the one pushback I would give you is I don't think that macro is just risk management. I also think it shines a light on alpha opportunity pretty brightly.
Where to look?
Yeah,
it does help, but that's level 2 for maybe some of our listeners, because at first you cannot defeat macro as risk management. You cannot. You have to accept, as well as a way to then now look for alpha. That's a level that may make some fundamental investors a little bit more uncomfortable.
I'll give you an example, right? And it comes from the scenario planning podcast that we did, because it was one of the big success stories of my career. Also features AES, the power operator. So in the technology era, when I managed money, so 99 to 2000, before it all collapsed.
Up until recently, those were the halcyon years. But for COVID, that was the height of technology investing.
Yeah, no doubt. So in any case, I was a fundamental investor. I did care about valuation. That was important. It was frightening that companies were multi-billion dollars whose price to sales were like 40, 80, something scary like that. And I wanted a way to buy technology in a more valuation sensitive way. And this is part of the creative process. But what I understood was that all devices were starting to be more electric. And the thing that tipped it off for me was I bought an electric toothbrush. I'm like, holy cow, there's a piece of software on my toothbrush, right? So the breadth of technology available everywhere is amazing. Not only that, but the depth of technology is growing. They're now networked refrigerators, for example, that will tell you when to order a water filter and can automatically order it for you because it's Wi-Fi connected to Whirlpool's website. Ridiculous, in my opinion. But nonetheless, there was also a depth of technology story. My insight using the electric toothbrush was that was an electricity story. That was not just a technology story. All of those things were electricity stories. Is there a way I can own electricity cheaply? Absolutely there was, because governments around the world simultaneously, macro story, were starting to come out from behind the Iron Curtain. They were starting to privatize power assets. AES was one of the companies that was purchasing those power assets. And so I purchased AES fairly cheaply. You bought a utility. Who would think to buy a utility as a technology play? That's where macro is an alpha opportunity.
This is why I say energy has to be thought of, because the demand for energy is not going down. That's an issue. Well, that leads us into semiconductors, the ubiquity of the need of semiconductors in our world. If data is the new oil, semiconductors are the drills. Well, do we have any issues with semiconductor supply chains or where they're produced or what they're... Oh, folks, we could dig in on this. But Jason, you know what I think I'd like to do right now?
Q&A?
Yeah, I'd like to open this up for questions because we've got enough time left where we may be able to get some interesting dialogue going. You can either come on and unmute or chat in the question. Alam, I think you have a comment or a question.
With weather, so would commodities be affected by weather? They would, right?
Yes.
That's like a major asset class.
The way I look at commodities, now we're going a little deeper. Oh, somebody likes the weeds. All right, so spread all the commodities out horizontally on a line, and we go from ag, we go to precious metals, we go to industrial metals, we go to energy. All right, we can discuss the different range. Which ones are renewable because they grow naturally? Which ones are less renewable? Which ones are correlate highly to GDP? Which ones operate independent of GDP? So I have to answer those questions when I look across the entire commodity complex before I'm willing to even approach commodities. Commodities generally are more tactical, but there's a couple of those that you could say, wow, that sounds like they could be evergreen, like industrial metals, as an example, versus it's judgment. Right, Alam, I'm being very careful about being too prescriptive, but that's how I think about commodities, is I think through the process of those comparables.
And I will add, commodities have a political dimension which most fundamental investors don't pay attention to. Those who invest in commodities exclusively, the traders absolutely understand this. I had a debate with a colleague who shall remain nameless when oil was above $100 per barrel. And I was an energy analyst, for those of you on the call who don't know, at one point in my career. And I said that I thought that the actual value of oil was probably in the mid-20s. And he was apoplectic that I didn't understand supply and demand, and that the price was above 100 only because of supply and demand. I said to this person, you're leaving out the political dimension of this, right? That's how many governments that use oil as the entirety of their budget make a living. And they're thinking long-term about how to do this, and they would rather produce less and have a higher price and put the squeeze on Western economies than they would, necessarily overproduce for the benefit of others. And he absolutely disagreed. And well, as everybody knows, the price fell quite considerably. And the problem in his analysis was he was a bottom-up guy. All he cared about was supply and demand, economic growth. I was like, you have to understand the political dimension to this. That is a macro factor brought into your analysis about the commodity.
If you don't respect that you are in water, bad things could happen. Anyone else chat in or additional questions? We are happy to entertain. Alam.
Was George Soros, he's known for his infamous taking down the Bank of England, him and a group of other hedge fund managers. It was currencies that he was mainly playing around with. I was listening to one of the CFO of George Soros' fund, because he's moved on to doing more political things now. And she said that he stepped away from making macro calls, and the overall portfolio is less than 5% is in macro. So what's your take on currencies, and what's your take on making those kind of calls? Because it's a lot of it attached to your career risk also.
I have two thoughts on currencies. Number one, the least predictable in any period of time of virtually any factor, macro, micro, or otherwise, vastly political. That's point number one. You can probably understand where point number two is going to go now. I think currency trading is a mug's game. I think the only people that are making money on currency trading are the traders, are the banks that are clipping the spreads, and investors, broadly speaking, I can't say everyone, are just giving away profits. But back when Soros made that giant bet, there were very few currency traders as compared to today. There was very little flow as compared to today. So what we have to respect is all investment strategies generally are not evergreen.
My take is currencies puzzle me. I have zero aptitude for understanding it. I tried to make those predictions early on in my career, and it was bewildering to me. But then so too were the movements of the market. Even the stock market and the direction it would go on a daily basis eluded me, not my skill set.
Yeah, so Olam, thank you for calling out the one area that I won't go near.
and me too. That doesn't mean people didn't. I've known people who are quite talented actually with the currency thing. The people I've known who do that well, like Soros, are very instinctual. Notice I didn't say intuitive, I said instinctual. I think currencies more so, my ignorant call on currencies is it's a jungle out there, and in a jungle you want to have good instincts. Any other questions?
There's something in the chat box, Jason. I don't know if it's a question or not. It's been there for a bit of time.
I had said hi to Barbara when she came in.
Ah, well. And Barbara's no longer with us.
We should, Eduardo, you've been on a number of these podcasts. So is Sanchita. We should poll for questions. Oh, Sanchita just disappeared.
You called her name. You scared her, Jason.
She disappeared. I almost feel like we have to call on them, at least to provide feedback, if nothing else.
Feedback is always welcome.
I enjoy these.
Yeah,
well, we got one piece of feedback, Jason. Let's shut off the call.
Exactly, Harry, and a good one. It's funny. We've teased our audience several times before that you'll listen to the podcast and then write us and email us in private, which happens pretty frequently. In any case, if there are no further questions, Michael, you think we should wrap it up?
I think so. If there are no further questions, I hope that we lived into the description, and Jason, thank you for trying to keep me on topic, that we sent out for the invite about having a little dialogue about the merits of macro. There is something very significant and real to using it, even for fundamental investors.
Yeah, and we promised to address purple,
yes.
And I would call myself, if purple is blue and red, right, and we'll call blue fundamental investing, I'd be more indigo than purple, probably. I would say macro is probably 20 to 25% of what I did. And, the remainder being traditional fundamental investing.
I'm purple.
I did have in my mind, hey, look, if I identify great managers of businesses, one of the factors I did care about was how well they managed macro factors.
Yeah, I'm purple. If it doesn't pass my macro perspectives, because first and foremost, I'm looking for evergreen. I don't want to be a trader. If it doesn't pass my macro perspectives, it's not getting it in. to the portfolio. So I have to say 50-50.
I got it.
Or what I used to call, I had a name for my portfolio strategy. Are you ready for this? The few, the proud that are still with us. It was Stractical. It was a blend of 50% strategic and 50% tactical.
Dude, that has to be trademarked. That's really good. Stractical.
Stractical, but it was based, it was based on Benjamin Graham. Benjamin Graham talked about having up to 75% of your portfolio in equities or a minimum of 25%. So I said, if I have 50% that is considered strategic as a long-term position, and I'm tactical up to half of the other, I'm actually just executing on Ben Graham's strategy for modern times.
Purple
Purple.
people eater. All right, so our next podcast is the 13th of May, and topic to be determined. Those of you still on the call, Alam, Eduardo, my mom is still on the call. Feel free to email us suggestions for what to cover. It's not that Michael and I don't have more. We actually have a long list of possible topics that we can talk about. But if there's one that you would like to hear, since you're the few, the proud that have stuck it out, email us. We'll consider that topic. We've already done a couple like that where the audience has determined what the topic was. So thank you very much for joining us, and we'll see you in 2 weeks' time.
Bye for now.
Thanks.